Good afternoon. Welcome, everyone. Thank you for joining us today. I'm Beth Parker with Pentegra. If you have any questions during the presentation, please submit them through the question box. We'll answer as many questions as we can at the end. Tomorrow, you'll receive an email with a link to replay today's broadcast. Let's get started. Hosting today is Chuck Coldwell, Vice President, National Director, Consulting and BOLI Services. Chuck is going to provide an overview of the pension valuation process and the results. Welcome, Chuck. Thanks as always for hosting. I'll let you take it away.
Well, thanks very much, Beth. Hello, everyone. Thanks again for joining us this afternoon. This has kind of become an annual event, reviewing the defined benefit plan annual actuarial valuation and plan costs. So I hope you enjoy the next half an hour or so. Some of you may know me, but my name is Chuck Coldwell. I've been here a long time. I've enjoyed working with clients all over the country. We have many consultants who serve as your primary relationship manager. We get involved with you in talking about all of your plans and products. But when it comes to the pension plan, talking about your costs, your plan provisions, how the valuation process works, etc. So what I'd like to do over the next couple of minutes is talk a little bit about, first, the multiple employer plan that you're in. We do have single employer plans as well, but this group should all be in the multiple employer plan. And as some of you may know, it's been around a long time. It's a defined benefit plan trust. It's a not-for-profit trust, and it has about 148 clients in it and about $4 billion of assets. And it was created back in the 40s by the Federal Home Loan Bank System. So they created us in a rather unique situation, and they wanted somebody to take care of the plan by providing all the services. So we do it all under one roof. You get your actuarial services, your consulting and investment services, and legal, all from Pentegra. But the way it was structured was really unique in that, as a multiple employer plan, our president and the board of this plan really provide two key services. Our president is the ERISA named plan administrator and the principal fiduciary. The board of directors is the plan sponsor. So if you guys looked in your summary plan descriptions, which is the employee booklet, you wouldn't see the name of your organization in there. It would be Pentegra, because we take on the principal fiduciary responsibility. And that includes things like setting the investment policy. We pick and choose and monitor the investment managers and their results. On the board is an investment committee reporting to the board, and we have obviously an investment staff working with both parties. So as a fiduciary, we fulfill three major fiduciary roles. And these are all sections of ERISA. There's Section 316, which is an administrative fiduciary. We fulfill that capacity. There's also the 321 and the 338 investment fiduciaries. We fulfill those roles and responsibilities as well. It doesn't eliminate fiduciary responsibility for our clients, but it does absorb the principal fiduciary responsibility. You, as clients, basically have three requirements: to send us accurate data, send us timely contributions, and we'll talk a little bit about that in a minute, and monitor Pentegra. And how do you monitor us? Well, we have our financials out on our website, and we produce two SOC reports, SOC 1 and 2, which are also out on our websites, and they're also on your plan sponsor site. So those give you some ways to take a look at Pentegra and the background. What I wanted to spend most of the afternoon on, however, is talking about your annual actuarial valuation process. This is a multiple employer plan whose plan year runs from July 1 to June 30. So every summer, we go through the valuation process where we're gathering data on all 148 clients and 25 to 30,000 participants. We get updates from our clients, and that leads us to prepare the valuation results. In the summer, we tend to send out a newsletter which gives you at least a quick preliminary view of what we think is happening for the current plan year. And as you'll see in a few minutes, every actuarial valuation includes this year's costs, so July 1, 22 through June 30, 23, as well as a projection for the following plan year. So I'll go through and I'll highlight each of those in a few minutes. For some employers, they have a quarterly contribution requirement, and that's always based on the prior year's results. And if you had a quarterly contribution requirement, which is due by October 15th, you would have received a letter from us in September. Frankly, most employers do not have these quarterly contribution requirements. So by now, all of you have received the latest valuation report. They all were sent out the second half of October. I'm also going to assume many of you have already spoken with your individual plan consultants to review this. If you haven't, it might be a good idea to give your consultant a call and just have them walk you through it. But I'm going to walk you through it in a generic statement in the next couple of minutes here. So you can see the table of contents. When I first started with Pentegra, this valuation report was 2 pages long. It's now about 40. And that's because over that time period, we've had an endless array of pension legislation that has been enacted, changing the way the valuation process works. So you see in this report, funding balances, if you have any employer credits, those are identified. We identify your funding requirements and minimum required contributions. We show you the maximum tax-deductible contributions. I mentioned already the projected results. There's accounting information in here. One thing that's very important is this is a multiple employer plan. There is no separate FASB expense report. What you contribute is generally what you deduct. And that's also outlined in Section 5. Then we talk about the plan assets. And when you look at the Section 6, keep in mind that that's covering the entire plan. So all $4 billion that are in that single investment trust. And then, of course, we wrap this up by talking about the actuarial assumptions that are used throughout the program and give you a summary of your plan provisions at the end. So very quickly here, the primary purpose of the Val report is simply to determine your funding requirements on an annual basis. And as I said a second ago, the important aspect for you to remember is there is a minimum required contribution. For those of you who may be overfunded, that minimum required contribution is probably just plan expenses. And again, I'll highlight that in a second. We show you a payment schedule. Some of you pay the contribution, and the first contribution is due by December 31st. Most clients actually make a single payment, but many clients, and you do have the right to do this, to spread it out over 3 payments. So you'll see that in the report too. And of course, what's very important to most clients is what's their funding status. And that gets a little bit more complicated only because when I focus on the principal valuation results page, on that page, you will see 3 different liability amounts, and you will see 3 different funding percentages. So it all depends on what we're focused on when we start talking about funding status. So really, to me, the most important pages here are the executive summary and the principal valuation page. So the principal valuation results, which are summarized on page Romanet 3, generally page 10 or 11 of the PDF itself, shows your demographic data of the bank or the employer at the top. And that's what all the data and the costs down below are based on. All right, that year's demographic data. The page that I'm going to show you and walk you through has your annual plan costs, has your plan liabilities and assets, and obviously the funding levels. It also includes the administrative costs, which are, and as I show you the page, there are 2 Pentegra costs and 2 insurance premiums. And then at the bottom of the page, you guys are probably all used to this by now, we show you pre-MAP 21 results. And MAP 21, Moving Ahead for Progress in the 21st Century, came out in 2012, prior to all the more recent legislation. And at the bottom of the page, we show you this current market liability as the third liability. So I will, again, walk you through all this in a second. So here's what I'm going to divide the executive summary page into two parts. The top half of the page, very importantly, shows you your minimum required contribution. So for this employer, it would be $557,000. I want to drop down a few, almost to the bottom of this page, and look at the single payment due. It's not 557, it's 573, because that 557 is a July 1 number, and the payment is due 6 months later, so there's 6 months of interest in there. So this client could either pay us $573,811 as a single payment by December 31st, or spread it over in 3 payments, $193 in December, next February, and next May. At the bottom of the executive summary, we show you your funded percentage. AFTAP is the adjusted funding target attainment percentage. Right? It's based on the pension legislation that's in effect and driving your requirements. But then you'll see that that's compared to 2 other funding status, one under PREMAP and one under the current market basis. And all you're really going to remember when I show you the next page is the difference of those funded statuses and resulting liabilities is all about interest rates. Each of these 3 bases uses a different interest rate to calculate the liability and therefore the funding status. And the last part of this is the projected results, which are simply outlined on page 11 of your valuation report. We show you a range, and I will show you that page in a few minutes. A range because we say, well, here's the most likely event, and what happens if we over or understate liabilities by 5%? That will change the cost, so we show you that. So this is a copy of a principal valuation results page. To make it easier, I'm going to break it down into 4 sections, and I'll take one section at a time. But this is really, to me, the key page and where we spend most of our time with our clients, just walking you through how this works, what it means, and what kind of options you may have. So let's look at section 1 first. I started off by explaining that when you look at your principal valuation results page, the top part, this section 1, is all about you. This is a snapshot of your active members. So for this client, there were 48 active members. What that means is these are 48 people who are employed and may or may not be earning benefits. That depends on what you've done with your plan. If you have an active plan, those 48 people are earning benefits for the next year. If you have a frozen plan, the plan is still alive, which is why we're calling them active, and they're still employed, but they may not be accruing benefits. You see the salary reported to us? Well, that drives your costs. You see the average age in vesting service. And then we show you the number of retired members. All right, so this bank has 43 retired members. They are receiving monthly benefits from us. The bank has 30 deferred vested members. Those are people who have terminated employment but are due a benefit in the future. And when you add the active members, this organization has 121 members of the plan in various statuses. So this population and the resulting salaries are what is being used to drive the cost of your program. The second section is very important. And again, when you look at this, keep in mind, this is your cost for the plan year. Target normal cost for a plan that is active. What I mean by that is at least some part of the population is accruing benefits currently. So the target normal cost for that type of plan is a year's worth of new benefits plus the administrative expense. The funding target, when you see those words, that's your plan liabilities, the value of all accrued benefits. The market value of plan assets are obviously the assets. We show you the investment rate of return for the ending June 30. We had a negative return this year. Last year, that return was 25 to 30%. So there is volatility, obviously, in a retirement program. We do a lot of things on the investment side to reduce volatility, and I'll mention that in a few minutes. You look at the assets and liabilities here. There's slightly more assets than liabilities in this example. Therefore, this plan is a little overfunded, about 103%. I'll mention orphans. We've talked about this in the past, but back in 2005, we changed the way this worked. If you were an employer prior to 2005 and you left, you would leave your participants behind and the assets and liabilities associated with them. These are people we call orphans. They're the responsibility of the plan to pay those benefits. We retain their liabilities, but we also retain the assets, and we will be paying these people in the future, if not already. In 2006, we changed the way we worked this so that if you left after 2006, you had to take all your participants with you, or you settled this by purchasing annuities. In other words, we weren't creating new orphans. So just for actuarial purposes, we allocate a portion of those orphan liabilities and assets, and you'll see it's a one-to-one correlation. Your orphan assets equal your orphan liabilities because we do that by policy. We want them 100% funded at all times. And we allocate these back to employers that were here prior to 2006. And it's really based on your liabilities to total plan liabilities to drive your allocation. So that's part of the liabilities and part of the assets when you look at your valuation report. So let's look at section 3. Remember now, 557 was the target normal cost for this client. Effective as of July 1, it would be a little higher with interest when it's paid on 12/31. I mentioned a minute ago that part of that target normal cost includes these expenses. All right, so this $96,211 is in that target normal cost. I also mentioned that there are 4 administrative fees. 2 of them are Pentegra fees. There's a per head charge, that participant fee. There's an asset-based fee based on the assets in your plan. And then there are 2 insurance premiums, generally. There's a flat rate premium, which is nothing more than a per head charge. And the Pension Benefit Guaranty Corporation is the one that drives those premiums. And then there's a variable rate premium that is a function of the funded status of the entire plan. And one of the things that is very different from last year is if you looked at this line item, 1368, under the variable rate premium, and compared it to last year, you will see for most of you a dramatic reduction. Why? We do not have an unfunded liability this year for PBGC purposes. PBGC uses a slightly different interest rate than all the rates I'm going to talk to today about, but it came up with an overfunded plan on a PBGC calculated basis. So there is a huge savings this year in administrative expense because we do not have that variable rate premium. What you see on that line is explained in the parenthetical. The 1368 is a portion of this client's orphan flat rate premium. Obviously, we have to pay premiums on all the orphans, and we allocate those premiums back to employers on a pro rata basis. You'll also note that this client has what we call a funded standard carryover balance, $778,000. What that represents is a credit that the employer can use if and when your minimum required contribution exceeds plan expenses. So if you have an overfunded plan today, your minimum required is just plan expenses. You can't use this credit. But if you had a target normal cost that was well above your minimum required, or if you were underfunded and had an amortization charge, you could use this credit to offset some of that. The difference between a carryover balance and a pre-funding balance is nothing but timing. PPA back in 2006 created the pre-funding balance. So any overfunding that a client might make, that is contributions over the minimum, could become a pre-funding balance. Anything before 2006 was a carryover balance. They do the same thing. If you make more contributions than the minimum required, you may be able to add to a pre-funding balance if you want. That would be explained in the valuation report. So let me talk a little bit about this. This page contains three different liabilities. The second section we looked at that had target normal cost, that had your assets and liabilities, also had an effective interest rate. And that effective interest rate is what we use by law, driven by pension legislation, to calculate the value of your liabilities. That rate is over 5% right now for just about all of our clients, if not all. And it's driven by pension legislation that says we have to use a 25-year average of corporate bonds. And last year, when the American Rescue Plan Act came out, it said, well, instead of using 90% of that average, which we had been using for some years, we got to use 95% of the average this year. So we got to use more of the average. If not for the American Rescue Plan Act, that interest rate would have been even lower. That interest rate, the 25-year average, is what's driving your minimum required contributions. We have shown you the pre-map results and the current market liability results for the last several years because a lot of our clients were saying that, the pension legislation has artificially increased interest rates. I'd much rather fund on a more real rate basis. Well, if that's what you want to do, a lot of clients were focusing on these pre-map results. It uses a much different interest rate. It uses a 24-month average of corporate bond yields, March to March. That results in a much lower interest rate, 2.85% in our example here, which increases the funding target or your liabilities. The lower the rate, the higher the liability. The higher the liability, the lower the funded ratio. So a lot of clients have been funding on this basis. So if you compared the alternate contribution of 1.4 million, that is much greater than the minimum required up above on this page. We've also shown you what it would take to get 100% funding on this basis. Not that many employers do that, but the information is there if you were interested. Look down below. And here was another major change from last year. The current market liability results are a function of a different interest rate yet. We all know that short-term interest rates have been rising quickly over the last 6 to 8 months. And when you're talking about averages of 24 months or 25 years, the current short interest rates are not affecting those yet. They do affect the current market liabilities effective interest rate immediately. And that's because rather than using an average of 24 months or 25 years, we're looking at a spot rate in June, on June 30th, a single day's rate. And so that process, by definition, means we are going to see short-term interest rate rises affecting this rate immediately. And if you went back to your last year's report, you would probably see a 170 to 200 basis point increase in that rate. And when that goes up, your liabilities go down. So what's happened here? The liabilities are still at a level for this client that on a shutdown basis, if you will, they're still underfunded. And that's one of the reasons we've included the current market liability results in your Val report. Is it meant to be a proxy? If you were thinking about shutting a plan down, how close are you to being fully funded on that basis? And this has gotten much closer this year because when you shut a plan down, what you're doing is, we'll do it on your behalf, is we go out to the insurance market and we get annuity quotes. And to shut the plan down, you'd be going out and buying annuities for all of your members, currently retired, term vested, your actives, and offloading those assets and liabilities and responsibility for paying benefits to an insurance carrier. Well, that 4.71% that we're using as an effective interest rate, calculating that liability, is very, very close to the current annuity purchase rates. So when you look at your own valuation reports and you look at that current market liability, you'll just see how close you might be on a proxy basis to arriving at a final liability for the plan. I would warn you, it is a proxy. It's not identical. There are pluses and minuses and adjustments that are made when you actually calculate your shutdown liability, but it is pretty close. So again, I will mention this for those of you who have active plans that you're still funding benefits. If you were in the past funding on a pre-MAP 21 basis, you might want to reconsider that this year. Because when you look at the current market liability and where liabilities are on an approximate shutdown basis, it may not be necessary to have to fund on that pre-MAP basis. So that's a discussion you should have with your consultant. Every one of our defined benefit plans clients have an assigned consultant who can walk you through your actual results. So let's look at this page. We have projected costs in the valuation report on page 11. So what I've talked about so far is your current plan year costs from July 1, 22 through June 30, 23. Page 11 talks about projected costs for next year. It's important to remember that at the top of that page, there's assumptions that go into those projections. We still believe that 25-year average that we use for your minimum required contributions will decrease. There's a 20 basis point decrease in the assumption. Despite a negative return June 30 of this year, we still assume for long-term investment purposes a 5% investment return. We continue to assume PBGC rates are not going down. They're probably going to go a little higher, and that all clients contribute just the minimum required contribution. So those are the assumptions that go into the calculation of your projected benefits. The one thing obviously we cannot project is what happens on a demographic basis. If you're still enrolling people, who'd you enroll? How old were they? What are their salaries? Did people retire or terminate? Anybody pass away? That's all part of the valuation process that we go through over the summer. So when you look at page 11, the bottom line on this is we do a projection for the following plan year. We give you 3 projections, A, B, and C. You will see that B is bolded. That's because B is our best guess at this point in time. We have A and C in case we either over or underestimate liabilities by 5%. What would that do to your costs? So line one is your target normal cost. That is a year's worth of new benefits if you're still accruing benefits, and your plan expenses, which are on line 4, $98,763. Look at the funded status of these plans. They range from 90% to 106%, depending upon that liability value. If the plan is underfunded in column A, which this plan is 90% funded, you would be required to also contribute, in addition to the target normal cost, an amortization charge. One of the things that the American Rescue Plan Act did is it extended the years over which you can amortize the unfunded liability. It was 7 years. A long time ago, it was 15 years. Well, we are now back to 15 years. So that has reduced amortization charges for clients. So if we had, again, underestimated liabilities by 5% and you were underfunded, you would have your estimated target normal cost, which would be a little bit higher in A than B because liabilities were up more than we anticipated. And your total minimum required contribution would be $688. Our best guess, however, is that you're still going to be overfunded in this example. Therefore, target normal cost is what you must contribute. And it would be a little less if we overestimated liabilities. They were in fact lower. There would be a little bit of surplus here, and that would reduce line 1 in column C. So what is this telling you? Remember those credit balances. If you have a funding balance, we're here on this bottom of the page saying, well, your minimum required is more than plan expenses in each one of those instances, you may use your credit balance to help offset some of that. We have to collect the estimated expenses, $98,000 here, in cash because we have to turn around and pay the PBGC and others. But anything over that, you could use your credit balance. The very end of the report has a summary of your plan provisions. This is a good reminder of if you're still accruing benefits, what your formula is, what your salary definition is. Normal retirement age is 65 for most plans. What your early retirement age is, that may differ. If you're still enrolling people, we would show you your eligibility requirements. And if you have active service, death, and disability benefits, and if you offer lump sums as a payment option, we would show all of that too. At the very end, if you made any changes, we would give you a quick summary of any changes from the prior year. So I covered a fair amount of material here in a short period of time. I think the takeaways for me would be the principal valuation page is probably the most important page. That summarizes your demographics, your minimum required contribution, your target normal cost, your funding status, plan expenses, and those various liability amounts. You're in a rather unique plan, given that we are the principal fiduciary here. We're leaving you of the principal fiduciary responsibility and liability. It's one of the reasons why we maintain fiduciary liability insurance, of which you guys share a portion of the premium. That protects our staff, it protects our board, and it protects our participating employers. I would certainly suggest that if you haven't already, that you reach out to your plan consultant. I know they are all in the process of reaching out to you, but I would certainly suggest that if you haven't, you go through the report with your own specific results with your plan consultant. And they certainly can help you with questions regarding cost. If you want to change a plan design, that's what they're there for. So I've just about taken up a half an hour of your time. Beth, you could check for me whether there's any questions submitted. This is being recorded,
Check.
so there will be a recording out there. Yeah, go ahead, Beth.
Right, sorry to interrupt. I was just going to say at this time, we do not have any questions, but tomorrow, if you've thought about a question, when you receive the recording link, you can email me and let me know your questions, and we'll get them answered.
Okay, well then I'll simply thank everybody for their time this afternoon, and do let us know if you have any questions. Thank you.
Thank you for joining, everyone.